They just changed the rules overnight. Silver was the first target. And if you think this is about a commodity market squeeze from 3 years ago, you've already missed what's happening right now. Because what they did to silver wasn't the end of something. It was the blueprint, a stress test, a proof of concept for what comes next when physical reality collides. With paper promises at a scale the system can't suppress anymore. Let me show you what actually happened. Not the version you saw on the news. The one they needed you to forget. January 2021. A decentralized wave of retail buyers started accumulating physical silver. Not futures, not ETFs, actual metal. Bars, coins, anything they could withdraw from the system. Within 72 hours, every major online bullion dealer in North America went dark. Not sold out, dark. Websites crashed, phone lines jammed. Premiums on physical silver exploded to 30, 40, sometimes 50% over spot price. Meanwhile, the paper price on the COMEX barely moved. In fact, it dropped. You were told it was a failed squeeze, that retail lost interest, that silver was too big to corner. But here's what they didn't tell you. The COMEX changed the margin requirements mid-game. They raised the cost to hold a futures position by 18% in a single night. No warning, no vote, just a memo. And suddenly, the squeeze pressure evaporated, not because demand disappeared, because the cost of applying that demand became unsustainable for anyone without institutional capital. That's not a free market. That's a circuit breaker, disguised as risk management. Now ask yourself why they did that for silver and not for GameStop. GameStop was a stock, contained, siloed. You can halt trading on a stock. You can restrict buying through brokers. It's messy, but it's manageable. Silver is different. Silver sits underneath the entire industrial economy. It's in every smartphone, every solar panel, every EV battery, every 5G tower, every medical device. It's the most conductive metal on Earth. There is no substitute for most of its applications. And here's the problem. There isn't enough of it. Global silver mine production has been falling since 2016, not because miners don't want to dig it up, because the easy deposits are gone. What's left requires deeper drilling, harder rock, lower grades. It costs more energy to extract less metal. And 70% of silver isn't even mined for silver. It comes as a byproduct of copper, lead, and zinc operations, which means silver supply is tied to the demand for other metals. When those slow down, silver production collapses as a side effect. But demand? Demand is accelerating. Solar panel installations are growing exponentially. A single solar farm uses millions of ounces. The EV transition is supposed to add 88 million ounces of annual demand by 2030. Every AI data center being built requires silver for thermal interface materials and circuit boards. This isn't speculative. These are projects already funded, already breaking ground, already ordering components. The industrial demand alone is outpacing new supply by roughly 200 million ounces per year. That's the size of the deficit. And it's widening. So where's the silver coming from? Inventory. Above ground stockpiles, recycled material. And here's where it gets strange. The COMEX warehouse stocks have been bleeding for years. In 2020, they held over 400 million ounces. Today, it's under 270 million. That's a 33% drawdown. Registered silver, the portion available for delivery, is under 50 million ounces. That's less than 60 days of global industrial consumption. For a market that's supposed to be liquid, deep, and stable, those numbers are skeletal. But the paper market? The paper market says everything's fine. On the COMEX, the open interest in silver futures represents over 900 million ounces. That's 18 times the registered physical inventory. In other words, for every ounce of real silver available for delivery, there are 18 claims on it. And all of those claims are considered equally valid until someone actually asks for the metal. That's not a market. That's a confidence game. And it works as long as nobody calls the bluff. As long as futures traders roll their contracts forward, take cash settlements, play the price swings without ever demanding delivery. The system depends on that behavior. It requires it. Because the moment a critical mass of contract holders stands for delivery, the entire structure inverts. Suddenly, the paper price doesn't matter. What matters is whether the metal exists. And if it doesn't, the price doesn't drift higher. It dislocates. This is why they changed the rules in 2021. Because for a brief moment, the wrong kind of buyer showed up. Buyers who didn't care about futures, didn't want leverage, didn't want cash settlement. They wanted metal. And the system couldn't handle it. Not because there was a lack of silver in the world, but because there was a lack of silver in the right place, at the right time, in the right form for delivery. The paper market had made promises the physical market couldn't keep. So they raised the cost of making those promises until the pressure stopped. Now, why does this matter today? Because the same mechanism is being applied everywhere, not just silver. Look at what happened in the nickel market in March 2022. The London Metal Exchange halted trading and retroactively canceled billions of dollars in trades after a Chinese producer faced a massive short squeeze. They rewound the market, erased transactions, change the outcome, not to protect the integrity of the market, but to protect a single participant who was on the wrong side of a physical delivery crisis. The LME said it was to prevent systemic risk, but what they really prevented was price discovery. The market was about to reveal the true cost of nickel when supply is genuinely scarce, and they couldn't allow that information to surface. This is the pattern. When paper markets lose control of physical assets, the response isn't to let the market clear. It's to change the rules. Halt trading, increase margins, cancel trades, redefine what counts as delivery. Anything to prevent the system from admitting it's overextended. And it's not just metals. Look at natural gas markets in Europe. In 2022, when prices spiked and traders faced delivery obligations they couldn't meet, exchanges imposed emergency position limits and forced liquidations. Look at treasury markets. When volatility surged in March 2020, the Federal Reserve stepped in and bought over $1 trillion in bonds in a matter of weeks, not to stabilize the economy, to stabilize the market itself, because primary dealers were on the edge of failing to deliver. The plumbing was breaking. Every time a physical constraint threatens to expose the gap between what's promised and what's available, institutions intervene. Not with supply, with rule changes, with liquidity injections, with margin hikes, with trading halts. They manage perception, they buy time, but they don't fix the underlying problem. Because the underlying problem is mathematical. You can't print silver, you can't conjure nickel, you can't create oil with a keystroke. And when the gap between paper claims and physical inventory becomes too obvious, no amount of rule changes will matter. Silver was the first target because it was the easiest to contain. The market is small, retail participation is fragmented. The industrial buyers are long-term contracts, not spot buyers. So when the squeeze started, they could isolate it. But the logic of that squeeze is spreading. It's not about Reddit forums anymore. It's about sovereign buyers, industrial users, and central banks realizing that holding paper claims on physical assets is a liability in a world where supply chains are fracturing and geopolitical blocks are forming. China is stockpiling copper, aluminum, rare earths. Not for next year. For the next decade. They're not buying futures. They're buying metal, storing it, removing it from global circulation. Because they understand that in a fragmented world, physical assets are power. You can't run an industrial economy on derivatives. You need the actual material. And if you don't secure it now, you will be bidding against everyone else later when the price is 10 times higher and availability is zero. This is why the rules keep changing. Because the system was built for a world of abundance, stable supply chains, and cooperative global trade. That world is ending. What's replacing it is a world of supply shocks, export controls, and strategic hoarding. And in that world, the paper markets are a dangerous fiction. Silver was the warning. The moment when the system showed you what it will do when physical reality starts to matter more than financial engineering. They change the rules to protect the structure. But the structure isn't real. It's a consensus. And consensus breaks when enough people stop believing it. Right now, we're in the part of the cycle where price is being managed, where volatility is being dampened, where every dip is presented as proof that the squeeze was a fad, that demand is weakening, that everything's under control, but inventory is still falling. Industrial demand is still rising. Mine supply is still constrained. The math hasn't changed. Only the narrative has. And the longer the price stays suppressed, the worse the dislocation will be when it breaks. Because every month that passes with silver trading below the cost of production, mines shut down. Every quarter that industrial users secure metal at artificially low prices, they lock in more demand that future supply can't meet. The system is borrowing from the future. And the bill is coming due. You won't see it in the headlines, you won't hear it from analysts, but you'll see it in delivery delays, in rising premiums, in restricted allocations, in force majeure clauses being triggered, in contract settlements moving from physical to cash. These are the signs that the market is running out of slack, that the gap between what's promised and what exists is closing. You won't see it in the headlines, you won't hear it from analysts, but you'll see it in delivery delays, in rising premiums, in restricted allocations, in force majeure clauses being triggered, in contract settlements moving from physical to cash. These are the signs that the market is running out of slack, that the gap between what's promised and what exists is closing. They changed the rules overnight because they had to, because the alternative was admitting the market was broken. And they'll change the rules again. Every time physical demand threatens to overwhelm paper supply, they'll intervene, they'll adjust margins, they'll halt trading, they'll redefine terms, they'll do whatever it takes to maintain the illusion of stability. But there's a limit. You can't change physics. You can't negotiate with geology. And you can't print metals. Silver was the first target. It won't be the last. The same dynamics are building in copper, in lithium, in cobalt, in nickel, in uranium. Every commodity that's essential for the energy transition, for industrial manufacturing, for military production. The paper markets are overextended. The The physical markets are tight, and the gap is widening. The rules will change again, but next time it might not be enough, because the people who understand what's happening aren't waiting for permission. They're not trading futures. They're taking delivery. They're moving metal. They're securing supply. And when enough of them do that, the market won't just squeeze. It'll break. This isn't speculation. This is math. The deficit is real. The inventory is falling. The demand is locked in. The only question is how long they can keep the price disconnected from reality. And the answer is not much longer. Silver was the test. You're watching the rollout.